Hello, ladies and gentlemen, and welcome back. Well, we've just seen the core inflation numbers come out for the US, and look, let's face it, they were not good. Regardless, though, the markets bounced off the 3,500 zone after opening with a massive switch that was around 3% and a bit on some of the indices. We've now seen a ramp that is like no other. We've only had a few of these over the history of the stock market, and in today's video we'll be looking at some of the previous ones and to see what actually has happened off these 52-week lows. But regardless, there is a lot of opportunity now in markets, and while it may seem like you've missed the boat, there's actually a lot going on under the hood in other markets other than just stocks, which we will be covering today. So with bad numbers supposedly being good for the market, is this actually a turning point, or is it more just a squeeze that's going to be pushed later? Probably that one is more likely. 5% is now the possible expectation for April 2023 yields in America. It's getting pretty dangerous out there, guys, and you can see that we're in that incredibly volatile time. This is where things get serious. Well, welcome back everybody to the Daily Show, where we discuss markets around the world. And of course, today we'll be looking through the inflation numbers. We'll also be covering off the big data points that we've seen recently, the key levels, the lead indicators, and all of the charts that you could probably be wanting to look at right now. Let's talk about S&P 500 largest reversals and NASDAQ largest reversals from the 52-week low. Well, we've just entered a very serious reversal. That was a pump like no other. As you can see here, there are very few times in history where we've seen markets open so negative and then move to such a big positive after a 52-week low. Notice that we're in the illustrious territory of the global financial crisis with the S&P 500, and the swing was even more wild when you consider the NASDAQ, basically over 5% from the low to the high. This means that we're now in a point where squeezes could happen. The market could actually ramp, even though it may not make sense. And what I want to do is show you some of the previous times we've seen this on the S&P 500. So these are some of the points. This is one of the points here in January of 08. And you can see that candle that came through. It looks very, very similar to the type of candle that we have now, which we'll look at very, very soon. Then we have the similarity with just before the really horror show watershed moment of the global financial crisis. In fact, we had two reads in here, but this is the one I wanted to look at. So we actually saw another bullish day after this, and then a sell-off that led on to that watershed moment, a significant, massive drop that happened after that. And if you've been following our videos, this is still a distinct possibility even after such a huge ramp day. This is not the day to feel FOMO. It's the day to practice patience, to look for the highest kind of quality trades, and to always remember there's another opportunity, especially if you're a trader and not an investor, around somewhere else. Here's the one from 2011. You can see this one actually did make a new low, and then that was the end. And you could notice here that there was a lot of thrust that came after this, consecutive bullish, 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 bullish. And at the time of recording, we do have a market that's moving up in the futures action. So when we take ourselves to where we are right now, and we just have a quick look here, you'll notice that there's that big ramp candle, and it came with a decent wick down below. We've got a gap that could fill here at 37.44. We'll cover this later. And we've got a whole bunch of different little pullback levels that could be met by small miniature demand, at least temporarily. There's also some amazing squeeze levels moving forward if the markets do start to ramp. So opportunity is going to be around the corner on markets such as this. Let's talk about inflation though, because of course this was what everyone was discussing. We saw here basically the inflation number rose a little bit more than expected. It was expected to be about 0.4%. We ended up getting 0.6%. And what was most notable about it was things like food continued to be sticky. You can see here on this chart that we have the overall food kind of broken down, and it still looks very, very worrying on the surface. If we look at where all of the inflation has been recently, it's been in airfares, it's been in household energy, another very sticky one on the report if you've had a look at it. Food at home's been horrible, transportation, and we're also seeing things like medical expenses as well start to ramp up. So we ended up getting an overall inflation reading of 8.2. The expectation was 8.1. when you look under the surface, most of the drops in inflation were through fuel, energy, the ones that you would have expected, which is why quite a few people were expecting the inflation number to come in a little bit under expectations, but it just didn't. It's still sticky, and this leads us into things like the CCP meeting this weekend on the 16th becoming even more important, because if they don't, let's say, move their policy and they continue to do lockdowns, what's that going to do to things like inflation? Is it going to hurt the supply chain again? There's a lot of uncertainty in this market, so be careful out there, guys. All right, let's talk about similarities with previous negative 20% years. So as you can see here, we're basically in the kind of line of average declines actually here. Here's the average, here's where the market was, and of course it's now done this little bounce up. So it's basically at that point where previous times the markets have turned around. Let's have a look now at all of the previous main kind of times that we've seen this occur. 2001, we all know what happened there. This was actually near that bottoming period. 2007, the one that's most closely correlated right now, we were close to the watershed moment that led to really significant further declines. And then in things like 1973, we were close to the low. 1965, we were basically at the low. And 1961, again, we were at the low. So if we're taking a look at all of this data in purpose, unless it's the GFC or something similar to that, this was actually a turning point in markets. And it makes sense when you look at some of these data points coming up. Let's also discuss some other reads we've got here. So this is just the read about those since 1952. What happened there, of course, is the global financial crisis. You can see that watershed moment led on, and the lows from every other data point. So statistically, yes, most of the time we'd seen bullish turnaround throughout these next weeks and months, but time will tell. We're going to need to break some pretty serious levels. Remember, this is inflation. This is a totally different scenario. We're just using these data points to get a little bit more information about what is possible. Now, when the Sp500 had 6 consecutive losses at a 52-week low in a bear market, again, we tended to see like near the lows, but as you'll notice here, in over 3 of these data points, we weren't at the low yet. We actually had the watershed moment here in global financial crisis. We had a significant decline here in the 70s and in the 60s as well, significant decline. Many more percentage points to come. Notice the stats over the next couple of months, very negative in this occurrence. If we go over here to when we have over a 2% gap down, again, after the 52-week low, there's that correlation. You can really see the global financial crisis. You can also see that we were sometimes at lows through these reads. So this is why it's so difficult, because if we do end up making a new low underneath this low that we've just put in at 3,500, that could really signify that full fear coming through. Maybe it happens after the CCP meeting if they don't switch. Maybe it's another data point in the future. Here's the same kind of data point here, but now it's only 1% down, open, close. We've used this one before in 2020 and 2022. And again, the reads here for the next couple of days have generally been positive, followed by more of a coin flip or negative situation about a week or two later. So that's, again, pointing to maybe a little bit of a ramp here, a bit of a squeeze and potentially turnaround. These are the two main kind of seasonal approaches. If you were in any other year, midterm election years tend to really turn here at this point, and usually September into October is negative with that November turn. We're now at the time of this recording in the middle of October, so it shows us that, you know, the turn really should be happening if it's going to. Here's all of the bear markets and recoveries for the last 200 years if you wish to pause the video. And do remember, we've kicked off earnings season. So this could be another catalyst both ways in the market as well. You know, what's going to happen with the banks on Friday? This is what we're ahead of. Citi, Wells Fargo, JP Morgan, Morgan Stanley, they're all coming out with their reports. Will they show strength or negativity? And even do we want them to show strength in a point where the Federal Reserve has realistically been forced now to potentially raise rates at an extreme rate, and we'll talk about that very soon. So before we jump into the charts and we take a look at all the key levels we need to be watching, I want to say a big thank you to today's sponsor of the video, which is Tiger Brokers. Now, we live in a time here of insane news, so you want to have a news feed. Ideally, you use something like Tiger Brokers to be able to get feeds like this, to be able to have those kind of premium services. The Wall Street Journal here, Reuters, Bloomberg, all of the big ones all in a feed headline here. And a lot of these are the premium versions as well. So Tiger Brokers gives you that for being, of course, a client of their brokerage firm. Now, we are also in earnings season, and it is one of those times where you need to be aware of the stocks that you are in and whether they're going to have earnings. If you're interested in dividends, you can put that on. I personally love the weekly and monthly view grids so you can see everything and you can select the market you're interested in. Let's say you're not interested in any market but the US, you can select that. You can add your watch list in there as well. So that means that you can just look at the stocks you're in or even select position, which I really like. Being able to select these things is fantastic because it means that you can eliminate all the rubbish and just the things in your watch list or that you're actually trading at the time will come up in the earnings calendar. It's a great tool, and I definitely suggest that you consider checking out Tiger Brokers. Do remember, for any of the Australian and New Zealand audience, there's a special offer right now, 40 zip free stock and a whole bunch of other little extras if you fund the account with as little as 1 cent. But don't worry, for other members around the world, you can, of course, check out their links in the description, and there's a whole bunch of other opening bonuses. Thanks so much, guys. We'll see you now in the charts. So let's now jump into the charts and talk about what's going on. Now, a lot of you would have expected the VIX to jump significantly. We have expected that the VIX would hit like a 40 or a 45 like high when we're seeing the real capitulation of the market. Now, there was no real excuses for the VIX not to jump in the previous session, but I noticed that even though the stock market had opened down, the VIX was actually dropping through that session. Did the VIX precursor that the market was actually turned around? Well, I guess it did. It came off that 35. It's still a very high VIX reading, but we saw it drop through the session because, of course, the stock market went up. I was kind of hoping that the VIX would come out with a 40 or a 45 read to show us that fear capitulation had come in. That's not what's happened here in 2022. The VIX is very strange beast. Remember, previous history, if you haven't watched these videos, usually shows that the VIX spikes to an extreme level where we fear or have a capitulation in the markets, and that tends to mark near or close to the bottoms in markets overall. So why did markets go up? Well, I think it's mostly a squeeze style situation. Potentially markets have oversold even for this figure. Look, you can make a lot of different cases for it. Let's just call it this way though. It's doing the exact opposite of what people would think logically. And that's what markets often do. The price action's bullish at this stage. And of course, most people are going to be trying to sell into that strength yesterday. Hopefully no one got too badly beaten in that. Practice risk management whenever possible, guys. Let's look at the yields though, because this is where things got wild. And I posted on our Twitter at FX Evolution about this. 5% is now the expectation in April 2023. But look at the 2-year. The 2-year spiked to 4.4%. That's getting close to those 2006, 2007 highs. So we're approaching what I've always thought would be the breaking point for the US economy and worldwide economies, around 5 to 5.5%. If we have to push to 5.5 on yields, I'm really worried about the economies overall. I mean, you can already definitely say you'll be worried about debt, but this thing's pushing a 4.43. Let's have a look at the forward yield curves. So we'll take a look here at December. The spike now at 4.22, expecting quite a few rate hikes coming through. Let's have a look at April 2023. We almost tapped 5%, now 4.89. Look at that trajectory. Wild stuff, 4.89. September of 2023, 4.79. So basically, most likely, rate hike, very little cut. How these yield curves have changed over the last couple of weeks has been big. Then we have one rate cut expected by December of 2023 by the market. So it kind of goes like this, sits there for a while, one rate cut, and then sits there for ages. And I mean ages. Remember, the 2-year is expected to be at 4.5-ish%, 4.4. So that's basically saying that we're going to get one rate cut and then we're going to sit there for a long time. Can you imagine the pain that this is going to put on so many zombie businesses out there? There really could be more to come in these markets moving forward. But let's talk about the current market. Well, the dollar index reacted very interestingly, and it was probably the one that's giving us the most interesting kind of levels. So here's the dollar index, and you can see before the news event, it dropped down. It didn't quite get down to our demand level. We'll talk about that soon. But then it bounced to a new high and took that supply. So this is the supply we've had here for quite a while. It actually took the high and then swung it and instantly started reversing. And this was a day that took a lot of stop losses out. It took supplies, it took resistances, it took everything across the markets. And as we look at all of these stocks, you'll see why. Then we basically belted down and we moved underneath this level. Now we still have this area of demand, but from on the surface, you would think this is a turning point here for the markets. We made a peak, we then made a higher peak. We've got the trough in between and we've breached that trough towards the downside. So now you would think that reversals or markets moving back up should be met by sell demand. Yes, that's actually what's happened here. Over the last 24 hours, we've kind of changed the configuration on so many of these markets. Let's have a look at gold. So gold hit our testing demand down here. It was actually a really nice little trade in there. If you'd had the conviction to go with it, there was actually a really nice little buy in there, and it's bounced straight back up. Now, for it to go realistically long, it's going to need to take out this 1680 plus level. And at that point, you'd think pull back again, going towards the long side. For now, though, gold is sitting in an interesting zone. I don't think there's any particular trade here yet for gold, but I really like some of the setups that are happening from a technical level moving forward. Where there are potential trades, though, could be the euro or, of course, the dollar index. As we saw before, the dollar had broken through. I'd like to see the euro take these highs. So this is the previous little wicks here sitting at 98.14. And then you'll notice that I've got like a line coming through the middle of this structure. Most likely, if the euro does take this kind of level, usually from a technical standpoint, the market will come back and it will react off that middle structure where orders can sit in these markets. And this would be a very interesting level, obviously, for seeing turnaround stories around this little particular area. So yeah, the euro is on the precipice of a real turnaround story against what a lot of people are going to believe, which is going to be, you know, a strong dollar, weak euro situation due to all of this inflation stuff. Markets can be very fickle. Do want to take out this level first though, so that's around that 98.16, then pull back, and we'll update you as this happens. It might be 1 or 2 days away in terms of that type of thing. Even oil bounced off that secondary demand zone. We had this one here and this one here. We saw it come down, it hit that, and it instantly bounced and it moved pretty heavily up. I'd like to see oil now decline, but this is a first really significant turnaround for oil. Pullbacks into this structure again could be met now by buy demand, and you could make a bullish case now for oil, at least in the short term. Oil loves yields, and if yields are going up, oil loves it. I've long suggested or thought about oil going down overall, and of course I still stick with that plan longer term. You know, remember I was talking about this at 120 a barrel, but realistically for the short term, as these yields are spiking, oil tends to do well. When the yields start dropping, watch out for oil. Oil will usually drop at that point. Let's move over to the stock market now, and Tesla was probably one of the better trades through the session. We actually saw it take the lows of the previous points over here, and it took them and then instantly rallied straight back through that. Now, it hasn't gone to some key levels yet. We can see we've got a little alert here for it to break past that high, but I'm kind of suspicious of this move in some ways through stocks, and I'll show you through a whole bunch of stocks now why we might be looking at a ramp into a potential short. So if you take like the structure of this area, most likely kind of one of the key levels sits around here at that 240. So I could see Tesla, I could see stocks ramping here and moving into filling some of these gaps, and potentially at this level having a little bit of weakness. That was a previous demand. It was a previous little bit of buying. You could actually see it hit this and actually sell off. And this comes through quite a lot of stocks. Let's have a look underneath the hood. You can see here, it opens on that level, takes it, and then starts to ramp up. We're now entering the first level of structure, but this level holds a gap close as well. And you're going to see a gap close on quite a few stocks, all very similar levels. Here's Apple. It finally entered that bottoming wick that we saw, the demand from previous, and it just bulled. It went massive on the session. It was a very, very strong stock. Again, for Apple, it's that 145 kind of area, 148 area that holds that issue point for this particular stock. So will they ramp in? This is one of those more touched zones, probably one of those more traded zones for this particular stock. Microsoft actually did the business. I'm sure a few of you were looking at this stock. It hit that zone. It absolutely slammed it. And it just opened straight on that trend line and just bulled and bulled and bulled. I'm not sure what the percentage was for the day. Let's have a quick look here together. But it was a fairly significant turnaround. I mean, 7.26% on the day from that key level at Microsoft. So it does show you that setting up and being patient on the key levels can matter. We hit a 3,500 on the S&P. We hit Apple at that demand level. We had Tesla taking the lows. We had Nvidia taking the lows. We had so many stocks realistically sitting on these critical zones. So maybe it was due for a bounce. Now, during the time, it can be very difficult. It's hard to have stop losses at these kind of levels unless you know exactly what you're doing with these swing points. And yeah, even Nvidia bounced straight back above that low. Does this mean that there's not more pain to come? Absolutely not. But you could see that this could squeeze for a couple of sessions. And we'll talk about the pullback and the squeeze stories very soon as we go through the markets. Let's look at the one that basically slapped me in the face with a bunch of alerts, and that was the UK 100. It was super important for the FTSE to hold this zone. Demand, 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 or support. You could see all those buyers coming back in, and it took the low and just went boom, straight back up. Very interesting. You'll see I've got an alert set here at the 71 kind of 20 level. And the reason I have that is because this could become like a double bottom or a basing pattern. It's possible. More likely though, the market will come up here and it will start to have problems and potentially sell back off. This is the games that markets play, but that's a big wick and that saved what could have been a critical crash. The close is the key, guys. By the end of the day, if this thing had closed red on its lows, you know, I'm telling you from my perspective, any rally was going to be met by shutdown demand. It's that important with the closures, and this close had a giant wick. And it's the same story through a few of the markets. In fact, the European markets barely struggled through the session. You can see here the DAX didn't really care. Big volume coming back in, it just went kind of long. It's looking okay, I guess. The DAX is not looking negative. But let's now talk about the US markets. Now, here was the interesting one. We actually filled and we hit quite a lot of levels here on the Russell. The Russell sold off aggressively, the small caps, but it actually didn't make a new low. It held the base, it held the lows here, and it just went bang, straight in, taking out that alert that we had at 1711. And it again looks relatively bullish here on a chart. If you take a look at this big bullish candle. We saw 3 dojis. The market took the low, it came through, hit the base, didn't make any new point, and just went boom. This is now 1, 2, 3 times it's held this level. So it's going to be worthwhile setting an alert underneath here, because that's probably where you're getting that capitulation selling that's going to push stocks well under. If we take these lows now, you just know that they held so much demand in the past because they bounced so many times that if they get taken, it's going to be significant. It's just like with the FTSE. When the FTSE had closed underneath, significant stuff would be in store. So it's going to be interesting to see how the market reacts. You can see at the time of this recording, they're still ripping up. I could see it rip pretty strong over the next 24 hours, potentially hit into this little supply here and then have some issues. But I want to use the Sp500 the most with this. Here's the NASDAQ. It came off the secondary level. So if we scroll out here, we need to probably go with daily. You can see those wicks that were formed back in July of 2020. We found initial buyers in this box. We found the bigger buyers, obviously here. They've come back through, and we still have a lot of unfilled kind of zones here. So if we look at the NASDAQ, you'll notice we have unfilled gap sitting quite far above. So here it is, 11,489. Is the market going to do some kind of ramp, hit this level, pull back into a structure around here, and then we find out whether the buyers are really ready to recommit? This is definitely a leading concept or theory that I'm playing on here in the markets. If you consider the US 500, as we move over to that, it's a similar thing. Where's the gap? Well, the gap sits around 37.40. We'll just quickly grab it from here, 37.44. And you should have those marked on your chart. So 37.44. Just so happens that's also our box zone, because we know that that's where the non-farm payrolls result came in. So the market seems to be trying to squeeze this number. If it can squeeze into this level, this could be where the sellers recommit to the markets. So of course, if you're thinking, oh, well, you know, I think this is ridiculous, this market can't ramp. Well, remember, markets can stay irrational longer than you can potentially remain solvent. Practice your risk management, guys. But markets could come into this level, and this could be a turn point. And I think if it does turn, the most likely level that the markets then come back down to is somewhere between this 580 to 3,600. And this both means that there's two very significant levels moving forward. We've got that potential supply throughout this box here and maybe just this level. We fill a gap, we push that squeeze, then we come back down and we find out whether the market really wants to go bullish or not. This level here could be a very good kind of trade day. There's two cool trade days from a technical potential perspective. So very, very nice kind of movement here. Even though it looks insane, I could still think that there's some method to the madness. That would work with the dollar index as well. We see that initial kind of movement against the DXY. Then we see maybe the DXY continue to strengthen after now it's broken through the lows. As that strengthens, it pushes through, and then we get the reversal on the DXY because they're interlinked, they're interconnected, these markets, to a degree. Let's have a look at Bitcoin. It was it was down to the wire. I mean, I laugh because, you know, this zone has just been so consistently bullish, and it really almost got destroyed. You can tell that it was just on the precipice of getting messed up here in terms of Bitcoin. If it had fallen through that 17.5 or 17, maybe even 18,000, we have to worry about that level. If that happens, watch out down below, guys. You know, I've always said it, negative 83 to 86% here is what my expectation is from top to bottom for Bitcoin. I'm still not overall long-term bullish on it just yet. I mean, you could make a case for it, I understand, but here's the rally, and you can see that there was a lot of structure through these previous points. So if it keeps rallying with the stocks, which I'd expect it to do so, if it then turns around, it's a similar story for Bitcoin. A pullback with the stock market after hopefully the stocks hit that supply level, or they hit that resistance, fill the gap, and then we move back down into this level around here, which sits between around that 19,000, 19,250. I'd love to see Bitcoin move up and then come back down to that zone to see if it can have a nice reaction there. For the news ahead, yeah, there's still more to come. As you can tell here, it's always good to have a calendar just so you can see the forecasts, the forecast 8.1, the reality 8.2, the forecast 0.4, the reality 0.6. And we move in now to the core retail sales and the prelim UOM sentiment. 1 hour before the New York market opens, that's 8:30 a.m. New York time, and then we move into the weekend. Now remember, guys, on the Sunday we have the CCP meeting. Unfortunately, this is now going to become a big story. What do they do? Do they reverse? They've got COVID cases in Shanghai again. I think it was like Golden Week just happened. There's a real case for shutdowns and lockdowns. They could spook the market. Remember last time we ramped into this news? Remember that? We ramped into all of this COVID infection. Then all of a sudden they shut down and the market just tanked. So you've got to be very, very, very careful here. Be nimble and fast. As always, if you're interested in finding out more about the sponsor of today's video, which is Tiger Brokers, definitely check them out, guys. There's a whole bunch of links in the description with some special deals. I believe for the Australian and New Zealand audience, you get an extra bonus for being part of the FX Evolution community, 40 free zip stock when you fund the account with, I think, as little as 1 cent or greater, and open it very, very soon. Thanks so much for watching, guys. Remember to subscribe, smash that like button, and we'll see you in the next video. Bye for now.